Central bank buying and inflation will underpin the price of gold over the next decade. So says our next guest, Ian Williams. He's Chairman and Chief Executive of Specialist Asset Manager Charteris. He joins us now live from the London Stock Exchange. Ian, thanks for being here. Central banks, let's start there. Who's buying and why?
Well, basically the Asian central banks are buyers. For the last decade, the story of central bank gold sales has really been one of net sales by European central banks and other official bodies like the IMF. But now what's happening is that the Asian central banks have now entered the market as buyers, and they're now bigger buyers than any residual gold that the Western central banks have left to sell. So we think for the next few years, whereas for the last few years central banks have been net sellers of gold, we think now central banks as a whole, for the aggregate of the world, will be net buyers.
Okay, now this is about reserve diversification, right? So how much of a proportion of gold do you think central banks are likely to be trying to target to hold in their foreign exchange reserves?
Well, I think potentially quite a lot. I mean, if you take China, which is probably the biggest, it's got about $2.5 trillion of reserves, foreign exchange reserves. Of that, we think about 90% is invested in US Treasury bonds and about 1% in gold. Well, that's probably the wrong mix, and we expect to see the proportion of Treasury bonds go down and the proportion of gold go up, and something similar for most of the other Asian central banks as well.
So this is a function of what's happening in surplus countries. So look for what's happening with surplus countries where they're establishing their trade surpluses, and then see that recycled into gold.
Yes, I mean it's partly because of a rebalancing of the portfolios, and it's partly because of quantitative easing in the United States is bringing about a distrust as the US dollar, how much of a store of value it's going to be, and also with all this printing of money, exactly how much of a good investment US Treasury bonds are.
Well, all right, so that brings us neatly, once we're into money supply, it brings us neatly into the inflation question. This is the other factor that's at play. Is that all about quantitative easing and what we've seen from there, or is it more about the inflation that you're seeing building in emerging markets?
Well, the expansion of monetary policy isn't just going on by the Federal Reserve or the Bank of England with its previous quantitative easing program. It's also quite strong monetary expansion in China coming through unsterilised foreign exchange intervention, and that's been going on for years. So there's quite a lot of liquidity around, but what seems to have happened is that with quantitative easing in America has seemed to have unnerved the Asian central banks and the Arab central banks, who are very big holders of US Treasury bonds, and they've decided that they want a much greater proportion of their currency reserves in gold, and similarly a lesser proportion, a lesser exposure to US Treasury bonds.
So, I mean, what do you think is an inflation problem? I mean, you know, we've all been inflation fighters in the G4 for much of the last 25, 30 years. Arguably, it's under control now. There is no inflation that you can see in the system. Why is that going to change?
Well, two things. A, the Federal Reserve is quite keen to fight deflation rather than inflation, and is prepared to create a bit of inflation to offset the deflation. That's unnerving some investors who think it might get a little bit out of control. If you take a snapshot today, you could argue that core inflation, what have you, is not really a problem. But I think the investors who are buying gold and switching away from US Treasury bonds are more focused in what's going to be happening maybe a year or two down the road, when some of this money starts to feed out into the system.
Okay, all right. Well, let's get on to some of the specifics of your fund and your analysis, what you're doing. This gold fund you launched in February of this year, up 43% since then. Gold's obviously been hitting successive record highs in recent weeks. What about bubble risk here? Is this what we're seeing?
No, I mean, if you sort of do some box-ticking tests for where the bubbles are, go back to what we've just been talking about the Chinese central bank, 90% in Treasury bonds, 1% in gold. Which one looks like the crowded trade? Which one looks like the bubble? Bond yields are at the lowest yields since the Second World War, and a very, very crowded trade. So guess where the bubble is?
All right, well, fair enough. What do you think then about the best way to get exposure to gold? I mean, is it through mining companies? I mean, that's where you are, right? It's mining companies that you're focused on.
Yeah, I mean, our fund can choose. I mean, if we think the metal is a better buy than the mining shares, we can have 100% of the fund in the metal. Or if we think the mining shares are cheap relative to the metal, we can have 100% in mining shares. At the moment, we have 100% in mining shares. We think the mining shares are incredibly cheap relative to the metal. If you look back to the just before Lehman's collapsed, the HUI index, which is the index of leading gold shares, was around about 500. Gold was $1,000 an ounce. Gold is $1,400 an ounce today. That mining index is still around 500. So there's an enormous amount of catching up to do by the mining companies, and you can back that up. Every time we meet CEOs of all the mining shares that we invest in, they all say they've all got costs roughly around $400, $500 an ounce. They're selling their gold unhedged at $1,400 an ounce. They're all making spitting off quite heavy amounts of free cash flow. And so the mining shares look in tremendous shape at the moment.
Okay, Ian, that's where we'll have to leave it. Thanks for being with us. We appreciate your time. That's Ian Williams there from Charteris. Well, do stay with Reuters Insiders for more on asset allocation. At 15:30 GMT on Monday, we'll talk to Joachim Faber from Allianz Global Investors on his outlook for 2011. I'm Nick Edwards, and this is Reuters.